Okay, so have you ever stopped to wonder why so many millionaires own apartment buildings, while the average person spends decades relying almost entirely on the stock market? Welcome to this explainer, where we're going to decode the actual mechanics of wealth building. Now, most people believe traditional equities are the ultimate path to financial freedom, right? The standard advice is to buy index funds, invest consistently, wait 30 long years, and eventually, hopefully, become wealthy. But the surprising truth is that many self-made millionaires didn't actually build their fortunes through stocks alone. They built them through apartments. So why is it that apartments seem to mint so many millionaires? What do wealthy investors fundamentally understand about real estate that the average index fund investor simply doesn't? And if you're starting out with a smaller amount of capital, you might be wondering, should you be deploying it into stocks or looking at real estate? Today, we are breaking down the specific mechanical financial advantages that make apartments one of the most powerful wealth-building assets ever created.
Here's a quick look at the agenda for our 5-part explainer today. We're going to start with 1, the wealth mindset shift. Then move right into 2, the cash flow engine, 3, the power of leverage, 4, debt and inflation benefits, and finally, 5, the reality of real estate. Let's get right into it.
Part 1, the wealth mindset shift, the fundamental difference between working for money and buying assets.
You see, the real dividing line in wealth creation honestly comes down to capital allocation. Every single month, the average earner uses their income to fund liabilities. We're talking rent, car payments, subscriptions, expenses that constantly drain capital. But the wealthy? They operate entirely differently. Their income is deployed almost exclusively to acquire assets. Think about it like this. Imagine controlling a 20-unit building. Instead of relying on a single employer for your livelihood, you instantly secure 20 separate streams of income. When your income no longer depends entirely on your personal time, well, building wealth becomes exponentially easier.
Moving on to part 2, the cash flow engine, and how you get paid while you wait.
Unlike stocks, where you're basically crossing your fingers and relying heavily on decades of price appreciation, real estate relies on immediate math. Let's say an apartment building generates $20,000 a month in revenue. After carving out 75% for expenses, your maintenance, taxes, insurance, and property management, you are left with a 25% profit margin. That translates to $5,000 in pure profit every single month, absolutely regardless of whether the broader economic market goes up or down.
And that translates to $60,000 a year in pure cash flow. This is capital being generated for you completely passively. It creates ultimate optionality for you, allowing you to reinvest, pay down your debt faster, or go out and acquire more assets, completely independent of stock market volatility. Traditional equities might increase in value eventually, sure, but apartments, they literally pay you while you wait.
Which brings us to part 3, the power of leverage. This is the real secret to accelerated wealth. If cash flow is the engine, leverage is absolutely the rocket fuel. Just consider the capital efficiency for a second. To acquire $500,000 worth of equities, you generally need to have $500,000 in liquid cash sitting around. But to acquire a $500,000 real estate asset, commercial leverage allows you to put down just 20%. So for just $100,000, you now control a $500,000 asset. The bank steps in and provides the remaining capital, massively amplifying your purchasing power.
Now watch what happens to the math. When that $500,000 property appreciates by a fairly standard 10%, it gains $50,000 in total value. But because your actual cash investment was only $100,000, that standard 10% market bump actually translates into a massive 50% return on your deployed capital. I mean, that is the undeniable mathematical advantage of responsible leverage. The average earner uses debt to buy depreciating liabilities. Wealthy investors use debt to buy income-producing assets that multiply their returns.
All right, part 4, debt and inflation benefits, or what I like to call the double wealth effect.
This system creates this incredible double wealth effect. You simultaneously have 2 massive forces acting on your balance sheet. First, every month, tenant rent pays down your principal loan balance. And at the exact same time, the broader property value is steadily climbing. So, the widening gap between your shrinking debt and your appreciating asset is pure, unadulterated equity growth, and it's subsidized entirely by someone else paying rent.
Add inflation into the mix, and you uncover a truly unique advantage. While inflation normally drives up our everyday living costs, it also drives up rental income and property values. However, your fixed-rate mortgage payment, it remains exactly the same. So you are essentially repaying the bank with tomorrow's inflated dollars, which hold way less purchasing power than the dollars you originally borrowed.
In this ecosystem, inflation literally acts as a tailwind for real estate investors. Let's shift gears to Part 5, the reality of real estate. Why apartments are absolutely not perfect.
Okay, let's pause for a very objective reality check here. Real estate is not magic. Tenants can and do stop paying, requiring really stressful and costly evictions. Major capital expenditures, like when roofs cave in or boilers break, are real headaches. Markets dip, and variable interest rates can absolutely crush your cash flow. Plus, we have to admit it is highly illiquid compared to a stock you can dump in 3 seconds from your phone. It's inflexible and requires significant upfront capital and genuine effort. And honestly, this is exactly why the most sophisticated investors don't just pick one, they diversify across both asset classes.
But the true power of multifamily real estate lies in how these forces all stack together. You've got immediate cash flow, leveraged returns, subsidized loan paydown, and inflation-backed appreciation. When you lock those 4 steps together over a decade, they create an unstoppable financial momentum. It perfectly explains why big capital continually flows into apartments generation after generation.
So let's leave it with this. The goal isn't to work harder for money. The goal is to own assets that work for you. The math absolutely proves that apartments build wealth. But the real question for you is, will you challenge your traditional mindset and actually put these systems to work for your future? Think about it. Thanks for joining us for this explainer, and we'll see you in the next one.